Preface. Due to the rapid changes encountered in the social, economical and technological status in the society, the financial market is becoming more volatile, causing a great impact on the capital investment made by the investor. In today's market scenario, investors need to make a wise decision on the type of financial investment the investor is intending to make. Fundamentally, there are two main types of investments that are available in the market, and they are a slow and steady income generating type of investment known as a defensive investment, and a high profit generating with a high risk oriented type of investment known as the growth investment. Generally, the investors are advised to consider a diverse portfolio of investments to gain maximum profit with lower risks catered to various economic conditions prevailing in the market. The diverse portfolio of an investor can include a combination of investments ranging from a stable, income-generating defensive investments, cash and fixed deposit, to a highly volatile and high profit-generating growth investment plans. While there are many pioneers who have contributed in the growth investment plan, the earnings cannot be guaranteed based on a single thumb of rule or by adopting any specific strategies. Some of the greatest investors who have contributed in the field of finance investments are Thomas Rowe Price Jr., Philip Fisher, Peter Lynch, John Templeton, and William J. O'Neill. These investors have adapted various types of investment styles, including the successful long-term growth investment style. However, none of these investors have completely adapted the growth investment style exclusively. Thomas Rowe Price Jr., known as the father of growth investment, started his own fund investment association in the year 1937. The investment style of this association is to market funds on well-managed and high-profit-oriented companies. Philip Fisher, a famous growth investor and founder of an investment management firm known as Fisher Investments, in the year 1931. Fisher mostly invested in the manufacturing companies and emphasized on focusing on a limited number of stocks that has the potential to outperform in sales and profit sector for a long term. He preferred to reinvest the earnings for the development of the company and emphasized to monitor the following key factors before investing in any company: tracking management quality, facilitating competitive edge, and recording consistent sales growth. William J. O'Neill stands out for his own investment strategy that considers both the quantitative and qualitative approaches for determining the potential of high-value stocks. Further, in his style of investment, he emphasizes on holding on to stocks that are of high value and selling out the stocks that are undervalued. While each of the great investors has implemented different investment styles to meet their financial objectives, there is no single thumb rule or strategy that promises high profit returns in the growth investment plan. Hence, the growth investment must be well planned by the investor through the mechanism of researching about the companies or the underlying properties before extending the capital investment and identifying the key performing fundamentals of the company to leverage high profits. Historically, the share stocks are considered to be one of the viable instruments for an investor to gain higher profits for a longer time period. While the share stocks provide ownership for the investors along with the voting rights in the company's profile, it is one of the risky trading activities available in the market. Hence, the growth investment plan requires a thorough understanding of basic fundamentals in order to meet the financial goals and objectives. Introduction. Growth investments in the financial market allow investors to gain above average profits for the capital investment with higher risk of losing the market value. Though there are many pioneers such as Peter Lynch, Thomas Rowe Price Jr. and Phil Fisher who have contributed in the growth investment sector, there is no single rule or strategy that guarantees to work in the favor of the investor at all times considering various economic conditions. However, the strategy can be tailored to work in the favor of the investor by evaluating the investor's capital requirements and preferences, the market performance in various sectors or industries. The company's performance in the market greatly impacts the capital returns gained by the investor. There are mainly two types of growth investments an investor can opt for: shares and property investment. The market values of these types of securities are highly volatile and needs to be monitored on a regular basis. While the shares can be easily traded through the online platform, the property trading needs more time and effort by the concerned investor. The capital investment from various shares that is pooled as growth fund is attributed with high rewards and high risk factors, and the growth rate of the company or country's economy plays a vital role in predicting the future prospectus of the share values. Additionally, the share values of the investor can be impacted by the type of growth industry the shares are owned. While there are many types of growth investment strategies and styles that are available in the market, the investor needs to consider the strategies and styles that best suits the investor financial needs and objectives. Lesson 1. Basic information on growth investment. Growth investment, a strategy to gain maximum capital appreciation by investing in underlying assets that shows above average growth for the capital investment. There are various ways of investing capital in today's market to earn profitable returns. Some of the well-known trading markets are stock market, mutual funds, systematic investment plans, fixed income plans, gold investments, real estate investments, to name a few. All these types of investments require the capital to be appreciated over a period of time, considering various risk factors involved in the finance market. Each of these financial markets is defined by various types of investment strategies and plans that determine the investor's returns. The key factors that are considered by the investor to invest in the finance market to get long-term and above-average growth benefits are: first, the emerging market in which the security can be traded at higher profits. Second, the size and stability factor of the company where the capital investment is made. For example, if the company ABC is earning gross profit year over year, then the company can be considered as stable. Third, the sector in which the investment is made. Fourth, the risk-taking capability of the investors for investing in the finance market. Emerging market. The economy of certain countries is still emerging, and the financial market in such emerging countries is considered to be more profitable for the capital investors with higher rate of risks expected. As the emerging countries are more open for integrating with the global marketplace for significantly increasing the economic freedom, improving standard of living, enhancing the social status with additional tolerance, there are more opportunities for gaining profits with the capital investment made in such emerging markets. Further, as the emerging markets are experiencing rapid informationalization, the community is willingly adopting the latest technology, products and services in the market. Hence, the growth investment strategy can be easily implemented in the emerging markets. Companies' performance. Investors are required to analyze the financial capability of the company to determine the capital appreciation. Generally, a company that is considered as a startup and is earning a steady financial growth year over year is capable of earning more capital appreciation as compared to other type of companies. Sometimes the capital appreciation of the startup companies with steady growth can demonstrate high performance and outperforms other big companies during recession times. Hence, it is recommended to carefully analyze the historical data of the company's performance in accordance with the financial market performance before choosing to invest in any specific company. Technology and innovation sector. The latest technology products, including the innovative products associated with various sectors, can earn high financial profits. For example, the innovative products that have an impact on the healthcare can gain maximum profits in the company's stock gain. Hence, the investors can invest based on the analysis of the company's portfolio, wherein the companies focused more on the latest technology, along with the innovations, are well poised to earn long-term profits. Investors' capital investment capability. Generally, aggressive investors tend to invest high capital over high risk in growth-oriented investments, such as private equity, penny stocks, foreign currency, real estates, and so on. These investments require the investor to speculate the growth changes and the risks encountered in the volatile market. In addition to considering the above factors in evaluating the growth investments, there are specific economic parameters that are applied in each of the finance marketing types the investor is intending to capitalize. For example, investors of the stock market can examine the company's net profit, also known as return on equity, earnings per share, EPS, and short-term earnings to determine the growth of the capital investment. Based on the investor's financial needs, investment objectives and risk tolerance capability, the finance market supports various types of investments for the investor. The types of investment include individual stocks and bonds, closed-end mutual funds, exchange-traded funds, and other alternative types of funds. As evaluating growth investment in a finance market is considered to be a complex task, investors are advised to understand the growth strategies and the subjects that enable the investor to gain maximum benefit by adapting different investment styles. Some of the basic topics that are covered in the following chapters to impart the growth investment knowledge for the investors include fundamental analysis of the economic conditions at a macro and micro level, technical analysis to determine the price movement of the secured underlying asset, conducting market research to enable investors to invest in a stable and profitable sector to gain maximum profit, applying relevant investment style and strategy to gain high profit with a capital investment. Lesson 2. Fundamental analysis. A method to evaluate a company's or industry's business financial growth based on both quantitative and qualitative factors that enable the investor to assess the intrinsic value of the underlying asset or security, which is considered for growth investment, is termed as fundamental analysis. The quantitative factors consider the health and stability factors of the secured assets in the finance market. Further, the qualitative factors include both macroeconomic conditions as well as microeconomic conditions to determine the overall performance of the secured assets. The macroeconomic conditions determines the economic performance considering the external market conditions or large-scale economy, such as the unemployment rate, interest rates, inflation rate, supply and demand ratio, GDP growth that can directly impact the growth investment for the underlying assets. The microeconomic conditions determine the economic performance considering the internal performance of the company. For example, the company's balance sheet, the technology and innovation sector, the liabilities, assets, revenue, earnings of the company or business are used to determine the financial capability and the growth factor for the investor. Further, the qualitative factors that affect the financial market of the securities include analyzing the company's or business organizational performance based on the functional management of the company or business, the growth investment track record for a stipulated period, the debt levels of the company, the dividend growth of the company, evaluation of the product strength, brand reputation, to name a few. Example on fundamental analysis. Assume that a company ABC forecasts that for first 5 years they will grow at the rate of 30% and thereafter, from 6th year, they will grow at the rate of 20%. With this assumption, a 5 years cash flow is added to evaluate the present value of the stock. Further, the cash flow statement following the 6th year is evaluated with the assumption that company will make profit of 20% thereon. The discounted cash flow will be evaluated all through the year, which will be compared with the present value of the company's stock. If the estimated value of the company is greater than the current market price, then it is recommended to buy the stock of that company. On the contrary, if the future value is lesser than the present value, then fundamental analyst will not indicate the investors to purchase share stocks from that company. Evaluating the growth investment for an underlying asset or security considering all the above listed factors enable the investor to opt for the best investment plan or to devise the best strategy to gain maximum benefit. Lesson 3. Technical analysis. While the fundamental analysis topic deals with analyzing intrinsic value for the securities considering the macroeconomic and the microeconomic condition of the securities for investment, the technical analysis concept deals with monitoring the direction of the money movement. The technical analysis tools available in the market enable the investor to predict the financial growth based on the historical and statistical data collected over a period of time. The technical analysis can be determined for a short-term investment, such as determining the price movement of a security within a day or within a month, or for a long-term investment using the monthly charts. Technical analysis for predicting the price movements of the security are implemented based on two well-known assumptions. First, the predicted price value of any security reflects the market value considering the overall finance market value associated with the security for both short-term as well as long-term growth investment. Second, the price movement of the security is to be determined based on identifiable patterns and trends that is plotted as a chart for a considerable period of time. Hence, the capital investment can be made based on these identifiable patterns and trends to gain profits that are attributed with close prediction. The assumptions listed above aids the investor to make capital investment based on the upward movement of the trend for the securities. As the experienced investor is capable of performing a good technical analysis with close prediction values, the novice or inexperienced investors can make use of various well-known technical trend analysis tools known as technical indicators to determine the price movement of the securities. Some of the well-known technical indicators include Relative Strength Index, Money Flow Index, Stochastics, Bar, Candlestick. The technical indicators perform technical analysis only based on the data sheets or chart that is maintained for the security. It does not consider the overall economic-related parameters that affect the market value price. Hence, these indicators can be used for predicting short-term market gains and to identify the entry and exit points for long-term market gains. An example of an underlying asset that had an apparent trend is ABC, wherein the trend is observed between the dates. The asset ABC value consistently moves downward in price. As the share values of the asset ABC moves in favor of the investor or moves against the investor's prediction, the share values of the asset ABC are compared against the previous profit value and the previous low value respectively to determine a specific pattern or trend regarding the movement of the share value of the asset ABC. Based on this pattern or trend, the investor can determine either to buy or sell the shares of the asset ABC. Lesson 4. Market analysis. As the number of securities is increasing enormously in the finance market, it becomes imperative for the investor to determine if it is feasible to gain profits by investing in the underlying asset with the existing market conditions. The term commonly used to completely understand the market value and the demand of the securities in the current market is termed as market research. The information collected from various sources, including external sources and internal sources pertaining a security, can be used to analyze and predict the market value of the security. Information extracted from external sources include market value data gathered from government census data, trade association reports, comparative study from other market sectors, and so on. Information extracted from internal sources include research study conducted within a company for the securities, revenue earned by the company or business for the securities, business plans and reports adapted for promoting the products in the market. By using the information gathered for the securities, the investor or the broker involved in the finance marketing can predict the financial outcome for the underlying assets based on the market research report. Further, based on the market analysis performed by the investor or by a third party involved in analyzing the data, a detailed report can be created by capturing various factors affecting the market value of the security. Additionally, the report can provide detailed information about the company performance, the stakeholder details of the company, profits history considering the security, and so on. The report can be generated by focusing on the product sector, industry sector, geographic region, along with actionable recommendations to enhance the profitability aspect for the capital investment. For example, A health-related product that entered the market in the year 1991 made a huge profit within 5 years, and the market value of this product almost doubled within 5 years. Hence, with the market analysis conducted during this period, the investors were encouraged to invest more in the health sector as compared to investing in any other sectors. Such information about the market analysis conducted within the specified period enables the investors to make wise choice in opting for the capital investment. One of the important reports that a company produces to determine the feasibility aspect of the security is the Return on Research Capital (RORC) report. In this report, the company clearly provides data about the cost incurred in the research and development (R&D) sector for the development of a particular product and monitors the market value of this product. Checking for the ratio of cost incurred in the research and development sector with the market value of the product, the company can decide whether or not to invest on the product based on the profit value predicted for the product. Here is an example to determine if the company is making profit by investing in the R&D sector of an organization. A formula used to compute the return on the research activity includes: return on research capital equals current year's gross profit to previous year research and development expenditure. ABQ, a company, has a gross profit for the year 2016 of $50 million. In the fiscal year 2015, ABQ has spent $15 million on research and development. To determine the return the company achieved for the research capital need to be calculated using the formula return on research capital equals $50 million to $15 million equals $3.33. Hence, for every dollar invested by the company's R&D department, a return of $3.33 is earned as profit. Further, there can be many such reports that can be produced for the security to cater to various needs of the investor. Performing analysis based on these reports aids the investor to predict the market value for the security. Lesson 5. Types of growth investments. The financial market provides various types of investments for an investor to meet the financial needs while addressing the risk-taking capability. Some of the common types of growth investment plans existing in the market are stocks. In this type of investment, the investors purchase the shares of the company to possess ownership of the assets. Based on the company's performance, value of the share stock varies, and the shareholders have the right to receive dividends from the companies. Bonds. A type investment wherein the investors offer loans to companies or agencies and is entitled to receive interest for these loans. Further, the bond's value can either increase or decrease based on the market value. Mutual funds. Allows the investor to invest small or large capital, and the capital investment received from various investors are pooled for purchasing shares and bonds catering to many sectors. The market value of the mutual funds will be closed by the end of the day, and the investor is entitled to receive the returns in the form of dividends, interest, capital gains. Further, the investor can sell or buy the bonds based on the volatile market value. Exchange-traded funds, ETFs. The ETFs are traded like stocks, and these funds are valued while the markets are open throughout the day. In addition to the above types of investment, the investor can opt for real estate investment, hedge funds, and private equity type funds. While it is important to understand the different types of growth investments that are available in the market, it is equally important for an investor to determine the investment portfolio and diversification required to generate more return on the capital investment. A portfolio is a collection of diversified investments of an investor that enables the investor to meet the financial objectives through the portfolio. For example, the investor can opt to invest in mutual funds, bonds, shares to maximize the capital investment. Further, the portfolio can be diversified based on the market conditions, considering the sectors that are moving in the forward direction. By opting for a diversified investment, the investors can increase the growth of the capital investment while mitigating the risk factor of losing the gains. Depending on the financial objectives of the investor, the capital investment can be diversified by allocating the capital value in various types of growth investment plans. For example, if the investor is interested in achieving above-average returns with mitigated risk factors and low maintenance activity for a long term, then the investor can opt to buy the following 3 shares by allocating different percentages of capital investment across the 3 shares: 60% stock market index fund, 30% international stock index fund, and 10% bond market index fund. Optionally, the investor can choose for a balanced fund comprising of a fixed allocation of stocks, bonds, and cash. Lesson 6. Growth investment plans and strategies. An experienced investor is capable of performing various types of analyses to predict the market value of a security. However, a novice investor can consult a third-party investor for making investment in various portfolios. A third-party investor can be an individual investor or a large entity that manages funds for other investors. In general, an individual investor manages the financial securities for smaller shares and performs the trading activity for the investors through the individual investor's account. Further, every trading activity managed by the individual investor is charged with fees, including the marketing and distribution fees. The institutional investor manages the financial securities for large shares and performs the trading activity independently. Further, every trading activity managed by the individual investor is charged with fees without the marketing and distribution fees. Owing to the number of shares managed by the individual investors and the institutional investors, the nature of financial market sectors handled by these investors are generally different. As the individual investors own a small number of shares, the investors make the capital investment in small companies. On the contrary, as the institutional investors own a large number of shares, the investors make the capital investment in large companies. Some of the sectors that are handled by the individual investors are bonds, options, share market, future contracts. Some of the sectors that are handled by the institutional investors are mutual funds, exchange-traded funds, pension funds, life insurance companies. A high volume of shares of large companies can be owned by the institutions based on the analysis of the market value of the shares. As purchasing a high volume of shares requires huge capital investment, the institutions need to analyze the finance report before making a decision of purchasing the shares. Further, if any of the institutions that have purchased a high volume of shares incurs loss and fails to recoup from the loss, then the insurance corporation designated by the government of the country takes the responsibility of selling the assets and closing the liabilities of the failed institution. The failed institution financial record details are shared with other institutions that are capable of buying the assets or shares. Also, the regulatory organization takes the responsibility of closing the debts of the depositor for the assets that are not purchased by other institutions. The investor can take help from the individual investor or the institutional investor to determine the best strategy and to earn profit for the capital investment in any financial market. Key ratios. Even before taking help from the individual investor or the institutional investor, the investor needs to understand the key ratios that provide an insight about the company's outlook, the company's stock valuation, and other factors related to the company. These factors enable the investors to invest in the right securities and with the right attitude for maximizing the profit gains. Some of the key ratios that are commonly used across the finance market are listed below. First, the price or earning ratio, a ratio between the current share price and the earning price per share during the previous 12 months. Second, the PEG ratio, the price or earnings ratio value divided by the estimated earnings growth rate for the next fiscal year. Higher the value of the ratio, higher the profit gained, and the share value of the company increases. So investors need to wait until the PER value reaches the desired market value. Third, the dividend yield ratio, a ratio between the dividends declared for each share considering the previous share price. Higher the ratio of value implies that the company's performance is increasing and the investors can consider investing in such companies. Fourth, the enterprise value and earnings before interest, taxes, depreciation and amortization, EV or EBITDA. This ratio determines the company's performance based on various factors and provides an enterprise value for the company. Fifth, the company's stock ratio determines the stock price of the company shares, and the investors are required to perform fundamental analysis on the stock ratio. Sixth, the return on equity ratio determines the profitability of the shareholders that is distributed among the shareholders. Seventh, the multiplier cash flow implies that the ratio of the stock price to the cash flows generated by the company is high and the investors can opt to sell the shares where the ratio value is determined to be high. Eighth, the payout ratio determines the shareholders' interest that is calculated by dividing the dividends per share and the earnings per share. Investors can opt to buy the shares that demonstrate a higher payout ratio. Company's financial health and stability factors. The above ratios define the commonly used key factors associated with a growth investment plan. Additionally, to determine the health and stability factor of the company as per National Association of Investors Corporation (NAIC), there are certain standard guidelines or associated values that can be used to predict the growth factor of the company. The company's performance can be predicted by reviewing the values associated with the growth factors. First, company's growth rate. A company of size between $400 million and $4 billion must demonstrate a growth of 7%. A company of size less than $400 million must demonstrate a growth of 12% during the previous 5 years. A company of size less than $4 million must demonstrate a growth of 5%. A company demonstrating these values can be considered to be poised with a growth factor. Second, the growth analysts claim that a 5-year growth rate of 10 to 12% is required for the companies to prove its credibility. Further, a detailed evaluation of this credibility is required to ascertain the realistic growth rate of the company. Third, the growth investors must determine the growth margin to calculate the profit earned by the company before tax is levied on the revenue. Fourth, ideally, the stock price of a company must double in 5 years. Hence, every year the stock price must increase by 15% for the company to be considered as a profitable unit. Fifth, the return on equity ROE factor determines the profit the company is making based on the share investments. For a financially stable company, the current year's ROE must be compared with the average of the ROE factor computed for the company, considering the previous 5 years. Growth investments and fund management. While the investors are looking for an opportunity in growth investment, the value of the shares projected by the growth investment may be confused with the share values projected by the value investment. Investors need to differentiate the share values projected by these two different types of investments. The growth investment focuses on the companies that are predicted with faster above average returns, and the share value is computed based on the revenue, earnings, and cash flows of the company. However, the value investment focuses on the companies that are matured and can provide stable income with less average returns, wherein the share value is considered to be lesser than its intrinsic value. The stock funds are classified based on the type of investment opted by the investor. Further, the investor can build a more diversified portfolio by choosing the type of investment and can also opt to mix both growth and value funds to earn higher gains. The investors can consider investing funds in different companies with varying sizes, which is commonly referred to as market capitalization. Large value funds. Funds are invested in companies with market values greater than $10 billion, wherein the market value is measured on various factors such as the price or earning ratio, the PEG ratio, the dividend yield, and so on. Large blend funds. Funds are invested in companies with market values greater than $10 billion, and the funds are invested in a combination of growth and value-oriented stocks. Large growth funds. Funds are invested in companies with market values greater than $10 billion that are poised for growth. In this type of funds, the main objective is to earn high profit from the capital investment instead of earning a steady long-term income. Mid-cap growth funds. Funds are invested in mid-sized companies that generally have market value between $2 billion and $10 billion, and the share values of these companies must demonstrate a potential for growth. Further, the growth funds are usually focused on producing capital gains rather than income. Small value funds. Funds are invested in companies with a market value below $2 billion, wherein the market value is supposed to be undervalued. Value can be determined by a variety of measures, including price-to-earnings ratio, price-to-book ratio, or dividend yield. Small blend funds. Funds are invested in companies with market values below $2 billion. These funds are invested in a combination of growth and value-oriented stocks. Small growth funds. Funds are invested in companies with a market value below $2 billion that are poised for growth. Growth funds are typically focused on generating capital gains rather than income. Types of growth. While the investor understands the investment style to be adapted for implementing the growth investment by considering the fund's type to be used, the efficiency of the gains achieved through this style provides information about the movement of the intrinsic value of the underlying asset or the company. Enhancing the intrinsic value of the underlying asset or the company removes the burden of adding more capital investment into the financial market. Hence, it is important for the investor to understand in detail about the different types of growth that investor has gained through the growth investment plan. The type of growth gained by the investor is generally determined on the basis of the reinvestment returns achieved as compared to the capital investment provided by the investor, and also based on the prevailing financial market conditions. Some of the common growth types that prevail in the market are explained below. If the return of the reinvestment value achieved is equal to the cost of the capital, then it implies that the intrinsic value of the underlying asset or the share value of the underlying asset is not affected by the reinvestment. Hence, there is no guarantee of gaining higher profit by investing in such company or underlying asset. If the return of the reinvestment value achieved is more than the cost of the capital, then it implies that the intrinsic value of the underlying asset or the share value of the underlying asset increases with the reinvestment. Hence, it is preferred to invest in such a company or underlying assets to gain long-term benefit. On the contrary, if the intrinsic value of the underlying asset or the share value of the underlying asset decreases with the reinvestment, then it is not preferred to invest in such a company or underlying asset. In another market scenario, as the inflation increases, the cost of the capital investment also increases. However, the intrinsic value of the company shares and all the underlying assets remains constant. Hence, the gains achieved through this type of growth is unpredictable. Finally, the most preferred type of growth that provides high profit returns is by demonstrating the productivity gains through cost control or by managing the economy scale. This type of growth enhances the value of the company and/or the underlying asset and is preferred by the investor for reinvestment. Brokerage firms and online trading platforms. While there are many fundamental concepts and topics that are to be understood in detail to implement the strategies for achieving the finance objectives, the investors can also opt for brokerage firms or other online applications for trading securities. The brokerage firms and the online trading platforms help the investor in analyzing the current market scenario and aid the investor in making wise decisions to get maximum gains from the capital investment and to achieve the financial objectives. Further, the brokerage firm helps the investor in managing the investment portfolio and allows the investor to trade the underlying assets online based on the market value of the securities. Since the brokerage firms are knowledgeable in managing the capital investments, the firms charge lowest transactional fees for managing the trading activity. The online trading platforms such as robo-advisors enable the investors to track the investments through phones from any location and at any instance. Due to the cutting-edge features supported by the online platforms, many established financial companies are opting for the online services augmented with a human advisor on a need basis. Another well-known online platform used in managing the Growth and Income Fund is Calamos Investments. Conclusion. As the financial market is volatile and complex, investors must possess a keen interest in understanding the concepts, acquiring the required skills, and getting the right attitude to become a successful investor. As there are various factors associated with the growth investment plan, a systematic study of the underlying concepts and implementing the right strategy to maximize the profit gains by mitigating the associated risks becomes a norm for the financial traders. By reading the above lessons, a novice investor can get information about the growth investment fundamentals and in turn prepares the investor to participate in the financial market more aggressively. The lessons are classified as follows. Lesson 1 provides the basic factors that govern the growth investment plan and the key factors to be considered by a successful investor. Lesson 2, through Lesson 4, provides information about various types of analyses that are commonly devised by the investor to predict the growth investment direction. Lesson 5 provides an overview of different types of investments an investor can participate based on the investor's financial needs and objectives. Lesson 6 provides information about various modes available for an investor to participate in the financial market trading activity and the key attributes required to become a successful investor in the finance market.